Hey guys, today we're going to be talking about 3 investing mistakes to avoid if you're a long-term investor. Let's face it, in investing and in life, there's a lot to be learned from mistakes, but we want to avoid them too. We don't want to be constantly stumbling around making mistake after mistake, or at least not repeating mistakes that we've made. Over the years as a financial advisor, I've seen some mistakes that people commonly make and things that I hear from investors, especially when markets get rough. So today we're going to be talking about 3 mistakes to avoid for long-term investors when markets get rough. Before we get started, be sure to subscribe. I want to make sure that you don't miss any of my videos on personal finance and investing. Your subscription really helps. And if you've got questions or you want to add to the conversation, please be sure to leave them in the comments section. All right, let's get into investing mistakes to avoid when markets get rough. First of all, this is geared toward long-term retirement savers. This is not a video for folks that are day trading or actively trading the markets, moving in and out of positions based on what the market is doing. This is for a vast majority of you out there who are diligently saving for retirement, putting money away. Maybe it's not retirement. Maybe you're putting money away for your kids' college education, and that has a 15-year time horizon or a 10-year time horizon. This is all focused on folks who are investing for the long term, not people that are day trading stocks. All right, investing mistake number 1, believing that every market downturn is the big one. Now, I understand it can be scary when you get your statement and see a negative return, or turning on the evening news and seeing that the markets had a big drop in one given day. It's understandable, and it's human nature to try to avoid danger. But every market pullback isn't necessarily the beginning of the big one. Having grown up in Southern California, I weathered my share of earthquakes. Every time the earth started rattling, the thought crossed my mind, is this the big one? And there's no doubt there have been some big earthquakes that have caused a lot of damage. But it's human nature to try to avoid danger. As soon as that ground starts rumbling, you think, oh my gosh, how long is this going to last? Is it going to get worse? But the next thing you know, the earth stops shaking and you're fine and you go on about your day. So the same thing happens with the stock market. It's normal for the market to go up and down. And it's also normal for the market to have a correction from time to time. So getting worked up or worried about a 2% or a 5% drop in the market over a given week or so really doesn't tell you anything about whether it's going to continue, get worse, or be the big market crash that everybody fears. Stock market corrections and periodic times of volatility in the market are a normal part of the process. It's not necessarily the sign that you're going to have a repeat of other very large market crashes in history like 2008 or all the other ones that have happened before. So don't make the mistake of getting scared off by a temporary period of market volatility or a market correction. It doesn't necessarily mean we're headed for the big one. Another common investing mistake I see investors make when markets get rough is they convince themselves that something must be wrong with their investments. Now, I get it. When you look at your investment portfolio and you see a negative return, or you see a particular investment within a broader portfolio not performing well, it's human nature to look at that and think that something must be wrong. However, if you're investing in a well-diversified, well-allocated, long-term investment portfolio, there are going to be times where one asset class underperforms another. In fact, you might have some asset classes and investments that look flat out horrible. It's not necessarily a sign that something is wrong. Another common mistake I see investors make when markets get rough is they try to wait until the market settles down before they start investing. A common question I get from clients when markets get rough or there's a period of volatility is they want to know whether they should sell everything, move to cash, and then invest when things settle down in the market. Waiting to invest until the market settles down is really market timing. And if you're a long-term investor, you really should try to avoid timing the market whenever possible. It's very difficult to time it right. And a lot of times you've got to time it exactly right twice in a row. You've got to pick the right time to sell and you've got to pick the right time to buy. That's extremely difficult. The reality is there is never an all clear signal to invest. There will always be risks out there, and the list goes on and on. If you wait for an all-clear signal to invest, you'll be waiting forever. Rather than trying to time the market, focus on time in the market. And just understand there will always be periods of volatility, and sometimes it's best to just weather the storm. I've written in much more detail about these common mistakes investors make when markets get rough. I'll make sure to put the link in the description area below this video. And please be sure to subscribe. Your subscription really makes a difference and really helps me continue to make these videos for you and your financial journey. Thanks for watching.